Have you ever noticed how some people just seem to make really smart money moves? Like they just have this knack for it. Well, today we're going to unlock some of those secrets. We're going to break down some really solid advice about investing and hopefully help you avoid some common pitfalls. And to do that, we're going to turn to one of the most iconic figures in the financial world, Warren Buffett. We've dug into one of his most famous interviews, and let me tell you, it's packed with wisdom. So stick with us to the very end because we're going to reveal some key takeaways that you won't want to miss. Okay, so the first big idea that really jumps out from Buffett's insights is this: never lose money. Now you might be thinking, duh, who wants to lose money?
What?
But this goes way deeper than just avoiding a bad investment here and there. It's about building a mindset where protecting your initial capital is the absolute top priority. Buffett himself has this great quote about it. He says,
"The first rule in investment is don't lose. And the second rule in investment is don't forget the first rule, and that's all the rules there are."
the first rule of investment is don't lose, and the second rule of investment is don't forget the first rule, and that's all the rules there are. So what does this actually mean in practice? Well, it means being really careful about the investments you choose, focusing on those that offer a margin of safety. It means making sure you're not taking on more risk than you can comfortably handle. And it means being okay with potentially missing out on some big gains. It means avoiding a potentially devastating loss. Because in the long run, avoiding those big losses is what allows the power of compounding to really work its magic. It's about slow and steady growth without those gut-wrenching drops that can really set you back. And that brings us to Buffett's second piece of wisdom, which I think is really fascinating. He says that investing temperament is more important than IQ.
You don't need tons of IQ in this business. You need a stable personality.
Now think about that for a second. He's basically saying that your ability to stay calm and rational under pressure is more valuable than just being really smart. He actually says it's the temperamental quality, not an intellectual quality. You don't need tons of IQ in this business. You need a stable personality. So it's about having discipline, patience, and the ability to resist getting swept up in the emotional roller coaster of the market. Because if you're constantly reacting to every little up and down, you're much more likely to make impulsive decisions that you'll regret later.
Oh, no.
The third point Buffett makes is all about thinking for yourself. He stresses that you shouldn't just blindly follow the crowd or buy into whatever the latest hot trend is. In his own words,
You're not right or wrong because 1,000 people agree with you. And you're not right or wrong because 1,000 people disagree with you. You're right because your facts and your reasoning are right.
so it's all about developing the ability to analyze things for yourself based on solid information and logic, and then having the confidence to stick to your conclusions even if they go against the grain. Don't be afraid to be a contrarian if your research and reasoning lead you in a different direction. Now this leads us to the fourth key principle that Buffett emphasizes, which is to invest in businesses, not stocks. What he's getting at here is that you shouldn't just be thinking about buying and selling pieces of paper. Instead, you should approach investing as if you're becoming a part owner of a company. He says,
I think most of the professional investors focus on what the stock is likely to do in the next year. But the real test of whether you're investing from a value standpoint or not is whether you care whether the stock market is open tomorrow. If you're making a good investment in a security, it shouldn't bother you if they close down the stock market for 5 years.
most of the professional investors do not really think of themselves as owning a piece of a business. But the real test is whether you care whether the stock market is open tomorrow. If you're making a good investment in this security, it shouldn't bother you if they close down the stock market for 5 years. So it's about focusing on the underlying health and long-term potential of the business itself, rather than getting caught up in the day-to-day fluctuations of the stock market. Now this ties in directly with Buffett's fifth point, which is that price does not equal value. Just because a stock is expensive doesn't mean it's a good investment. And conversely, a cheap stock isn't necessarily a bargain.
Prices don't tell me anything about a business. Business figures themselves tell me something about a business, but the price of a stock doesn't tell me anything about a business. I would rather value a stock or a business first and not even know the price, so that I'm not influenced by the price in establishing my valuation.
He puts it really succinctly. Prices don't tell me anything about a business. Business figures themselves tell me something about a business, but the price of a stock doesn't tell me anything about business. So you need to learn how to evaluate a company's intrinsic value based on factors like its earnings, assets, and growth potential. And then you can compare that value to the current market price to see if there's a margin of safety. Remember, you want to be buying $1 for 50 cents, not the other way around. Now the sixth point Buffett makes is all about cutting through the noise and distractions. The financial world is constantly bombarding us with information, opinions, predictions, and it can be really overwhelming. But Buffett stresses the importance of staying focused on what truly matters, which is the underlying fundamentals of the businesses you're investing in. He has this great analogy where he says,
Unlike Wall Street, you'll notice we don't have 50 people coming up and whispering in our ear. Get facts, not stimulation here.
So it's about tuning out the hype and the speculation and basing your decisions on solid research and analysis. Don't let yourself get swept up in the fear of missing out with the latest market frenzy. Remember, patience and discipline are your allies in investing. Now, before we move on to the next point, I want to quickly remind you to like this episode and subscribe to our channel, Rich by Friday, if you're enjoying this breakdown of Buffett's wisdom. We're passionate about helping you make smarter financial decisions. Your support really means a lot to us. Okay, so Buffett's 7th principle is all about staying within your circle of confidence. This is such an important concept because it basically means sticking to what you know. Invest in businesses and industries that you understand well enough to evaluate their value and risks. Don't try to be a jack of all trades in the investment world. It's much better to be a master of a few. Buffett says,
Intellectual process is defining your area of competence in valuing businesses, and then within that area of competence, finding whatever sells at the cheapest price in relation to value.
Intellectual process is defining your area of competence in valuing businesses, and then within that area of competence, finding whatever sells at the cheapest price in relation to value. So focus on building expertise in areas that genuinely interest you and that you have a knack for understanding. And then be patient and wait for opportunities to arise within those areas. And speaking of patience, that brings us to Buffett's 8th piece of advice, which he calls no cold strikes. This is a really powerful analogy that comes from the world of baseball.
They may be wonderful pitches to swing at, but if you don't know enough, you don't have to swing. And you can sit there and watch thousands of pitches, and finally you get one right there where you want it, something that you understand, and then you swing.
Buffett says, in the securities business, nothing is forced upon you. So there are no cold strikes in the business. You sit there and watch thousands of pitches, and finally you get one right there where you want it, and then you swing. So what he's saying is that you don't have to swing at every pitch. You can be selective and wait for the perfect opportunity. There's no pressure to act just because everyone else is buying or selling something. Take your time, do your research, and only invest when you're confident that you found a truly exceptional opportunity. And finally, Buffett's 9th point is all about keeping things simple. There's often this misconception that successful investing requires complex strategies and sophisticated techniques. But Buffett argues that simplicity can be incredibly effective. He says partly because it is so simple. The academics focus on all kinds of variables, but they aren't important. Stocks are just pieces of businesses.
Partly because it is so simple. But, the academics, for example, focus on all kinds of variables. It's not what a businessman thinks about in buying businesses.
So focus on understanding the fundamentals of businesses, buying them at reasonable prices, and then holding on for the long term. Don't get bogged down in trying to time the market or outsmart everyone else. Sometimes the most straightforward approach is the best. And there you have it, 9 fundamental principles from Warren Buffett for smarter investing. Remember to protect your capital, cultivate a rational mindset, think for yourself, invest in businesses, not stocks. Price does not equal value, avoid distractions, stay within your circle of competence, be patient, and keep things simple. These are the core ideas that have guided Buffett to incredible success, and they can help you achieve your financial goals as well. And before we wrap up, I'd love to hear your thoughts. Which of these principles do you find the most challenging to apply in your own investing? Leave a comment below, and let's continue the conversation. Thanks for joining us on this deep dive into the wisdom of Warren Buffett. Until next time.